When most people think about a mortgage, they focus on the interest rate and the monthly payment. Just as important is the type of the loan behind those numbers, because it affects how much cash you need up front and how easily you can adjust it later if life changes. Four of the most common different types of mortgages. The first one is the conventional loan, the FHA loan, the VA loan, and USDA loan. For the conventional loan, they're not backed by a government agency. They're offered by private lenders that follow guidelines from Fannie Mae and Freddie Mac. Qualified buyers can put as little as 3% down on the conventional loan. If you put less than 20% down, you usually have to pay private mortgage insurance, which protect the lender just in case you default on a loan. But it can be removed later once you build enough equity and you meet certain requirements. Moving forward to the FHA loan. FHA loans are backed by the Federal Housing Administration and are designed to be more forgiving. They typically allow down payments as low as 3.5% down and may be more flexible with past credit issues and higher debt levels than the conventional loan. Instead of private mortgage insurance, FHA loans use mortgage insurance premiums, which is an upfront amount that can be often financed into the loan, and the annual amount is built into your monthly payment. That insurance may stay for most of the loan, which can make FHA loans more expensive over the long term. Next, VA loan. VA loans are a benefit for eligible veterans, active duty service members, and sometimes surviving spouses. Many VA buyers can purchase with no money down, and a VA loan typically don't require monthly mortgage insurance. Most borrowers pay a one-time VA funding fee, though some are exempt from the funding fee. For those who qualify, the combination of no money down, competitive interest rates, and no monthly mortgage insurance can make VA loans a very powerful financing option. So the last type of loan we're going to discuss today is the USDA loan. USDA loans is backed by the U.S. Department of Agriculture and is focused on eligible rural and some suburban areas. Many USDA options allow no money down, which can be helpful if your incomes are very stable but your savings are still growing. Qualified, the property must be in an eligible area and there are income limits for the household. When those boxes are checked, USDA loans could offer a low-cost path to homeowners that's looking to buy in a decent area. Loan types don't just differ at closing, they also shape what comes next. Conventional borrowers may have more straightforward plans to remove from private mortgage insurance or refinancing as their equity grows. FHA borrowers sometimes refinance into a conventional loan to shed from FHA mortgage insurance. It's worth asking yourself how long you expect to stay in a home. Whether you think you'll move in again in a few years, and how comfortable you are with your total monthly payment. The right mortgage for you should support those answers and not work against them at all.